we're going to do tonight is take a high-level overview of Better Investing's stock selection methodology. That's the introduction we're going to be talking about. It's not about just stock investing in general. It's going to be very specific to the Better Investing stock selection methodology, which has been practiced by Better Investing members since 1951. And hasn't changed much at all over all those many years. So that's going to be where we're going to focus today. We're going to be at a pretty high level. To talk about everything we do in detail is best served for another class. Actually, that information is provided in series we make available out on the Better Investing website. So before I do get started, if you do hear me talk about any specific companies or you see the names of specific companies, we're just using those for demonstration and educational purposes only. I will not own shares in any of those companies if I mention them, and by mentioning them, it's not meant to be taken as a recommendation to go out and buy shares in those companies by any means. As you'll always hear a Better Investing instructor tell you, what we show you is what we're thinking about a company, but we always tell our members to do their own studies before they make a decision. That's always in our mantra. And if you're not familiar with Better Investing is a nonprofit investment education organization. Again, it's been around since 1951. We're the group that started the investment club movement really in this country, where back in the early 50s, it was very difficult for an individual to participate in the stock market and invest like we do these days. Information was very hard to come by. You had to purchase large blocks of stocks to own shares in a particular company. It was not meant for the average individual, and this organization made that more possible for the average individual by setting up clubs. As a club, the folks in the club could pool their education, their skills, their money, and everything you need to really successfully invest the way that the organization teaches. So we're the group that's helped folks for many, many years do this. We're a volunteer-based organization. We have volunteers all across the country in over 47 chapters, and those are folks that have been practicing this methodology for years and just want to give back. They want to help others learn what they've learned to help them become financially secure like they have become. So let's keep moving. I've got a lot to cover. I'm going to be talking fast, and that's just the way this presentation is. So bear with me, but please feel free also, in that same control panel on the right side of your screen, there's a question box that you can type in a question, and we have Treva Dildine and Charles Bard working in the back room that can help answer questions as we go along, and I'll pick some out toward the end, as I mentioned, as time permits. So let's go ahead and get started here. Our philosophy is very straightforward. So in a nutshell, we're that sleep at night type of investment organization, where we're not buying the high flyers. We're not investing on momentum. We're not looking at technical analysis. We are looking to invest our money in good, solid companies, and we look to do that over a long period of time. So we look for quality, as I mentioned. That's a big focus in the very beginning stages of our analysis. We're gonna identify a number of different features. We're going to look at them and make sure that the company matches up with the requirements that we're looking for a company. But we're going to be looking at this stuff from a historical perspective, because that's information we have. We can see how a company's performed, but that's great. But we're going to be very, very interested in what the company can do for us. This is an investment we're looking to make. We're looking to increase the value of the shares that we're considering buying, and how possible does it look? And we're going to be making some assumptions going forward, and look at what the company what the potential the company has going forward. So all of that's going to help us really ultimately get down to what is the company's sales and earnings are going to look like over the upcoming years, and see if it once again matches the requirements that we really expect out of a company. When we look at the fundamentals of a company, which is what we are. We're fundamental investors. We're looking at sales. We're looking at pre-tax profit. We're looking at the earnings. We're looking at return on investment, on invested capital. We're looking at that kind of data. That makes us fundamental data. Earnings is the driver. Earnings is the driver of price. So when we're very, very concerned, and we are very focused on the past performance of earnings growth and the consistency of that growth, and how we feel that company is going to grow its earnings going forward. And that's very, very important, because the one thing we know for sure is that the price follows earnings. Okay, we've seen that from day one. And when we make these assumptions going forward, and we provide all the guidance and education really that you need to help make these decisions, or you don't have to go out and buy some special crystal ball. We have a very common sense approach to making the assumptions about what the company's performance can be going forward. So don't let that kind of thing scare you. But after we make those assumptions, we only consider buying the company's stock when there's a possibility of making a return on our investment. You can find a wonderful quality company that matches up and meets all the criteria we look for in a good quality company. But if its shares of stock are selling at too high a price based on what we think how this company is going to grow going forward, then it's not a good investment. And that's what we're in this game for. We're in it for the investment. So a company like that may not be in a time, may not be the time to buy the shares of that company. That kind of a company goes on our watch list, and we wait, and hopefully the share price of that company will come down into a buy range where someday we can hopefully become a shareholder. But we do not just run in and dive headfirst into every good quality company we come across. Not a good approach. Our principles are also very straightforward. As I mentioned, we're fundamental investors, and these 4 principles have been around for a very, very long time. Commonsensical: invest regularly. Okay, that's just getting disciplined. If you're not already a stock investor, you need to be setting aside money, whether you're going to invest it right away or you're going to invest it in the near future. You need to get investing regularly, whether it's just money going into a bank account initially, or a brokerage account into a cash account. While you're getting yourself up to speed to make investment decisions, the key is to get doing. Okay, that's critical. We're gonna buy growth companies, and that's where we're going to be spending a lot of our time in this presentation, and that's where we spend most of our time as an organization, is in that piece of the pie right there. And then once you start putting together a portfolio, we're gonna make sure that we reinvest all our dividends, all the capital gains that come about as a result of a sale of any of the holdings, so that we can take full advantage of what's called compounding growth. And that's just magic in numbers. And if you're not familiar with compounding growth, you're going to want to get comfortable with it, because hopefully you're going to benefit from it as a long-term investor. And then finally, we work on putting together a nice diversified portfolio, and we provide guidance once again on what that looks like. So what is it we do as Better Investing investors? We're gonna identify good quality growth companies. That is actually pretty easy to do. Okay, especially at first glance. And we're gonna do a little exercise like that in this presentation, where we can look at just a graph and very quickly decide whether or not we're gonna take the extra steps to get a better understanding of the company to actually determine whether or not it's a good quality company, the one that we would consider looking at as a potential investment. But that's only after we verify a certain group of quality characteristics that we want to see. But so we're going to tonight. What we're going to do, we're going to look at a company very quickly, just its graph. We're going to be able to identify if it's something we want. But that's, like I said, that just gets us started. After we do that, we do a little deep dive. We do some verification, and only after we've verified that we're really looking at a good quality company do we consider what that company can do for us going forward. So the quality part of this really relies heavily on history. But like I mentioned to you earlier, it's what this company is going to do for us in the future is where the value proposition becomes as an investment. So once we've identified that good quality company, then we take the next steps of making some estimates about the potential the company has going forward. We'll walk through some of that tonight. And once we've put some numbers together, those numbers, the estimates, what we're really trying to get to there is we're trying to put together a potential high price for this company that we're studying and a potential low price over the next 5 years. And then what we do is we simply lay in the current price of the company, what it's selling for currently, and we see how closely related that current price is to our forecasted high and forecasted low. And that helps us determine whether or not the company is a buy, hold, or a sell. We'll talk more about that as I go forward. But that helps us determine, whether or not we're paying a fair price for that potential that we've estimated going forward. So let's look at the process. Whenever we're using our tools, and we have a what's called our stock selection guide. That's the hallmark tool of this organization. It's the tool that the organization was really built around, and it has taken on various forms, ultimately getting us to the very same point, but just look and feel has changed over the years, and we've tried to take full advantage of technology and feel we've built a very robust set of online stock selection guides that our members can benefit very well from. And those tools employ all of what we do with regard to our methodology is built right into these tools. When we're looking to analyze particular elements of a company or making estimates and that kind of thing, it's all right there in the tool. It's very intuitive, and our education is built around those as well, so that the whole package comes together to really help uh, put our members in the best way we think that they can really learn this thing called stock investing and take full advantage of it. So when we say when we talk about the tools, and you're going to see a number of different images and graphs and such throughout this presentation, everything you see that with that kind of an image, these are things that come right out of the tools. I'm not going to be able to go into the tools live. That again is something you would do for a much more in-depth presentation. But I would make sure you get in and touch these tools to see what they can do for you. Very important, because that's really what puts everything I'm saying tonight. It helps really paint the picture, and you can touch and feel it, and you'll be going, oh yeah, I remember when he was talking about that, and oh yeah, here's that area. It'll all be right there for you. So when we start working through the methodology and using the tool hand in hand, we start, like we talked about, in analyzing growth. This top bullet is like I say, this is the very beginning steps of just making sure we're looking at a good quality company. We're going to talk about some of the characteristics we look at that determine that. We can take a quick visual analysis, like I mentioned. We're going to take a quick look at some graphs. We can, 50 feet away, I can look at the graph on our tool and go, yep, I want to look more into that one. It's that easy. But then then you got to do some work. Then you need to do a little bit of examination and do a little research into the company and make sure that it's a sound growth company. one that you really would like to be an owner. That's what this is. I mean, investing in stocks is are words. You know, what we're doing is we're wanting to become a part owner of the company. This is our opportunity. Buying stock in a company is a way to become a part owner. So you're going to be looking at it from a very, very selfish perspective. Do I want to be an owner of this company? Your name is in that. You know, this is you. So we're going to make sure that the company, you're very, very comfortable with the company. It's going to meet our criteria, and you're going to understand it. You need to be able to understand the company you're studying so that you can talk to it. If you're spending a minute with somebody in an elevator and they ask you about the company, because that happens every day, you'd be able to very quickly tell them about this great company that you've found and studied and invested in, and are excited about its future potential, that kind of thing, and what it does. How does it make money? How's it going to make you money? Okay, so you're gonna understand all that stuff. That's all about building that comfort level, because as I mentioned, we have some forecasting to do. We have to make some assumptions about that potential going forward. And if you don't have a warm fuzzy, a good solid comfort level with regard to a company that you're studying, how can you possibly feel good about what you would project for that company's potential going forward? You can't. You're guessing, and that is not the game we play. Okay, we don't play games. We we take this investing thing very seriously, and either if you're comfortable, you're comfortable. If you're not, you walk. You put the whole thing on pause until you get comfortable, or maybe it's just something that you just simply will never invest in because you just don't get it. And there's companies like that. Think about different industries like the biotech industry. There's industries that you're not going to be able to get your head around with some of what's going on that these companies are doing. You read it and it may as well be in a different language, but there's growth in this industry, and there are good companies in there, but you're not going to be able to give that little 1 minute elevator speech to anybody because you just don't get it that much. When you get into an industry like that, what you'll find a lot of our folks will do is they'll branch off, and maybe they'll invest in an ETF, an exchange traded fund, or an index type mutual fund that invests in that sector, where those instruments, they don't invest in any one single company like you would. You would be owning a basket of companies in that industry. And that brings a comfort level to our investors, uh, in being able to and make an entry into that area of the business world. Okay. So there's different ways to do things. There's lots of ways to make money in this world. We're doing it one way that we're talking about tonight, but it doesn't rule out others. So again, let's get back up to the end of bullet one. We've got ourselves a nice comfort level going. We're good. We're good. We're good now to start talking about what can this company do for me in the future. So that's when we start to make some forecasts initially on the sales and earnings. And those are, the sales and earnings are going to help get us to what our high earnings per share could be for this company 5 years down the road. That's an important number, and we'll talk about it a little more in the future because it's going to help us in the next section when we get to this evaluating risk and reward, where we're forecasting what the potential high price and low price is. That's the information, as I mentioned, we're trying to get to. So we're going to use that estimated high earnings per share. We're going to put it into our little quick formula, which is basic math, and we are going to come up with a potential high price, and we're going to take another earnings per share number, blah blah blah, and we're going to get to a potential low price. And I'll show you this stuff. But in those two steps, and that's where we're going to do our forecasting in the forecast sales and earnings and the evaluating risk and reward. And we'll talk about that more. And once you have this information, once you've finished step 3, now you're talking valuation return. And that's where what we'll do is we'll take, based on the estimates you made and based on that current price, if you were to buy shares in that company, here's what your potential return would be based on that current price and the estimates that you made. So that just kind of buttons up the discussion on what the potential stock could be in the form of value to you. So let's get started. We're going to start with this first bullet point. We're going to look at that, analyze growth and evaluate management, and we're gonna bring in little bits of when it comes to the graphs I mentioned to you, and we'll talk about some of the specific criteria that we're going to look for here. Very quickly, we're looking at this is the interface of one of the tools that we use, and here's a graph that is providing a look at the company's sales, the green line at the top. Pre-tax profit, I didn't call that out. That's the purple guy here. And we have the blue line, which is our earnings per share data. And then we see the black lines with that are little, we have a little notch at the top and bottom. These are the price bars. These represent the 52-week high price and low price of the company's stock during these particular years. These are years at the bottom. So what we're looking for is the performance of this data initially when we're talking about this visual analysis thing. This is what I was mentioning to you. I could look at this graph 50 yards away and say, okay, I want to take a deeper look at this company. So this is just the very first step. We can do a quick yay or nay with regard to whether or not we're gonna work further to do our stock study. So let's move on to look at some of the specifics now. So when we're looking at a visual analysis, we're going to look at that sales and earnings, the pre-tax profit. Those are shown on that graph. The sales and earnings, we're looking for strong, which in the case of the visual, we're just looking for how steep is that line moving from left to right. As in a graph, when the line's moving upward from left to right, it's typically increasing in value, right? So we want to see steepness of the slope, okay? The steeper the slope, the better. If the closer you get to flat line, that's not called growth. And when you're going south or down, you're losing. Okay, that's negative, and that's not what we're looking for. So strong in our world is moving up to the right. As we move over to the right, that graph is moving up. And we're looking for that in the sales and the earnings. And not only is it moving up, but is it moving up consistently? You just saw an image in the previous slide here where you look at these guys, they're moving up, but how are they moving up? Look at this green sales line. Beautiful, I mean, straight line type growth. It's not all over the board. This company grows its revenues very consistently year after year after year, where they're not looking up and down and all around. Okay, management has a good handle on this company's ability to generate revenue or sales. So we're looking at the consistency is that straight lineness. And then pre-tax profit, that's a little different animal. We like steady, but we also like growing. Growing is always good, but when it comes to pre-tax profit, there's really there's pretty much a ceiling there. You're not gonna. You can't just keep going up like you would with revenue. There's a point where we expect to really stay consistent, and so steady or growing is a good thing. And as well as with percent earned on equity or ROE, you hear it referred to. That's return on shareholder equity. So when a company is profitable, they'll roll those profits into the company to grow it, okay, to keep growing that company. And when they do that, we expect that's our money as a shareholder. I mean, you have a vested interest in that. And how is management doing when it comes to reinvesting those dollars? Are they successful at growing that money at a good clip like we would expect out of our investment? Or would it be better if the company paid it out in the form of a dividend because they simply don't feel they could that they could make enough of a return that would be satisfactory to the investment or the shareholder? So that's another discussion. That's another one of those items we discuss and we look at closely. And again, we're looking for steady. It needs to remain steady, and slightly growing is always a good thing. But once again, it's typically only going to grow so much. But those are the other two items we're going to look at closely. Then we take a look at debt. We want to see how the company is structured, its capitalization is structured, what amount of stock and debt are they using to finance the organization's operations, and we want to keep an eye on this. We want to know if it's a company that uses debt regularly. That's very common. There are industries where there are very high levels of debt that are used by companies to in their operations, and that's the nature of the business. Others are not. Others rely heavily on cash, because a good, solid, growing company in certain industries will be cash cows, and they don't need to borrow. And but if we run into a company that is in an industry like that and they are borrowing a lot, why are they doing that? And do they do this as a part of their regular business, or did they get into trouble? Did they pay a dividend and didn't make enough money and they borrowing money to pay the dividend? We're going to look for red flags like that. Are they borrowing money to buy back shares? That's a big deal these days. So we're going to watch what they do with the debt. But carrying too much debt in general can get a company in trouble in hard times. The economy is cyclical, right? I mean, as we know about the bulls and the bears and the ups and downs of the overall market. When you have a ton of debt, and we all know this, if we know we're smart enough that we don't, as individuals, carry a lot of debt, because we know that in down times things can get tight. And same thing with companies. If they can't grow their sales and their earnings like they were when they took on that debt, and they still have that payment to make, that can get a company into deep trouble. And so we're gonna keep a close eye on it. So let's just take a quick look at some of these examples of the graph, okay? So again, the green line is the revenues, purple line is the pre-tax profit, and the blue is the earnings per share. And again, the black bars are the 52-week high-low. It's very easy to see in a case like this that we would look at this company and go, yeah, I'd like to know what company that is, what they do, and if they're the best at it. That's another part of the equation. We like growth companies, but we also want the companies that are actually leading their industry. We want the leaders. We want the companies driving the ship. Okay, not the guys that are chasing them. That can be a good thing at times. I'm not ruling those guys out, but when you're looking to build a good, solid portfolio to get out, at the start, for sure you want to be investing in the companies that are leading the industry. So this is a great example of what we would want to see. So we talked about the steepness of the slope, or the pitch on this guy, how the company is growing, strong and consistent sales and earnings. Strong is the pitch of that line, and actually in the program this application, the stock selection tool. This straight line you see here mixed in with raw data. The raw data are the big plots and the lines connecting them. And then you see this thin green line streaking through. That's a trend line, and that actually is a mathematical calculation that helps us determine the slope of that line, which is we turn that into our growth rate. Okay, from this straight line, we generate a growth rate. You're not seeing that information at this stage of the game. Okay, that's all in the tool. It's actually on this same screen in the tool. But right now, I'm just trying to show you the focus that you can just look from a distance and go, yep, I like the look of this. Okay, so yep, good features, all looking good. With any growth company, we would expect to see a company that is growing at a very high clip as a younger company. But as it matures, there's only so much market share a company is going to be able to gain, and you start to see a slowing of the growth, and that's very normal. but it needs to continue to grow nonetheless. And there's a lot to talk about there. We discussed that in our education. So we're looking at how that guy's sloping, all right, and at what rate, that kind of thing, and in relationship to sales. In other words, if our earnings dipping faster than the growth in sales, that kind of stuff. We're going to look at the various relationships between these graphed items, and look, just looking at this. And I know it's not real vivid to see or clear and obvious, but when you look at the distance between the green line here and the blue line here, so that's top line. Okay, the top line, when you hear someone, oh, what's your top line? Well, that's the revenue line. Okay, that's top line. And then the bottom line is the bottom line. That's the earnings, right? Earnings per share. So we see a particular size gap between these lines. We see it pretty consistent. Okay, but then you start to see it widen. What you're seeing then is actually the company is spending is less efficient in this area that it's growing. It's not as tight as it was down here. Okay, so it's costing more. There's more expenditure going on in this space right here that causes the blue line, the revenue, to be farther away from that green line. And that's something we want to watch. What did that? What's doing that? Is it the cost of materials are going up? What is it? There's questions we're going to ask ourselves. So we want to understand that story, right? We talked about we need to know where we're putting our money, where we are investing. And understanding this is critical. So we look at this very quickly. You can say, I want to take a closer look, but it's the story that these lines tell us that helps us determine whether or not it's going to be a potential investment. And remember, we talked about price follows earnings. Well, you see the earnings line moving in this direction. You see that trend line again. It has one of those little thin blues. That's the trend line. How is the price moving in relationship to the earnings? It's been pretty good overall and on average, let's say that. But you look at some years, there's different things going on here. The price was way up over here in '09 and came in 2010. When you look at the price that I mentioned, these are the 52-week high and low. When you see a narrow range like this, that's the market really having a pretty good beat on the company and having a good feel how to value it, how to price this thing in the market. But then you see the very next year, the 52-week high low is ginormous. It really expanded, and it did so even in 2011. That's the market telling you they don't know how to value this thing like they used to. So that puts that a level of uncertainty out there that drives you nuts as an investor. But this is some of these type of opportunities for folks like us when you're very comfortable knowing you're in a solid company that the management team is going to work its way through the odd things that happen like in 10 and 11. These type of opportunities where where that price dropped like this, that can be a great opportunity for investors like us to actually get in there and buy the company. There's one thing about growth companies that's very apparent to everybody. It's that they're good companies. These are not secrets. We're not trying to find a needle in a haystack here. This is stuff that everybody knows. Okay, that's in this game, and so that's where the price you pay for these type of companies is typically at a premium. Okay, because the big, large chunk of the market wants to own those companies, and that type of pressure on the number of shares a company has available is going to push its price up. But various things can cause levels of uncertainty, whether it's the company or it's the overall economy. Lots of things can play factors on how a company is priced at a particular period of time. And those are the times when we want to try to get in as a shareholder. When a company that is typically not overpriced, but priced at a premium, you'll do your stock selection guide And after all your assumptions and you've created your high low price over the next 5 years and you lay that current stock price in there, you just look and go, oh my gosh, it's a sell. It's not even close to being a buy. And that's life in this world because again, you're looking to try to buy into a very good quality company that everybody knows. So we look at these dips like this in price, where when that price went down in here, there's probably a very good opportunity that this company actually became a buy. And if your comfort level is such with this company that got you to buy the shares in the first place, you'd be buying now. That kind of thing. Those are great buying opportunities. And there's a lot of different reasons that those happen. And then you see, look at it, 2012, it tightened right back up. Okay, the uncertainty started to disappear even more in 13 and more in 14. 15 a little broad, not much. Very tight in 16. We're seeing just solid. Okay, this is just solid. As a shareholder, that's a beautiful thing. But then something happened, didn't it? It went sideways here. This is a little bit stronger of a dip, that widening of the expenses and such, the slowdown in earnings versus the shares, the revenues. There's some uncertainty. You can just see it. Okay, you don't even know what this company is, but you look at this and you would say, okay, what's going on here? And you want to know the story. So this is when you do a little deeper dive. This isn't the end of the world by any means, but it just tells us what we need to do. So there's other stuff we look at when it comes to these graphs, but that's that's what we're looking at from the visual analysis. Okay, we're always gonna look for that upward growth and the consistency in those sales and earnings. Here's another example of a different company, and you look at how this company was growing earnings relatively nicely over a good strong period of time. But then you look at these more recent 3 years, and this guy is turning into a flatliner. Okay, again, we buy growth, not flat lines. Okay, so when you see this, that for this long of a period, you've got a problem. Okay, that's a situation. And then you see this earnings or pre-tax profit and earnings just doing the same thing. We don't want any part of this. Okay, now there can be turnaround stories and that exist in these situations, but when you're just getting started investing in stocks and and you want to build a nice solid portfolio to get off the ground, this isn't where you want to be. Okay, you want to be in companies that look like in that previous slide. Okay, and you look at this guy, look, we were just talking about price. Look at what happened here in 15. The market went, whoa. Okay, what are you worth all of a sudden? We don't even know. So this is not something we want to get involved with. Then you get into something like this. You see big dips on the graph. That doesn't necessarily mean the end of the world, but how did the company come out of a dip like this? 2009 was disastrous, right? The financial industry, the global financial industry was just rocking to a point of almost being destroyed. You can expect some of this. There's a lot of companies that didn't even flinch during this period, but some did, and that's going to happen. How did they come out of it? So this one comes out of it okay in 1 year, flatlines another, and just takes a dive going south. Okay, not interested. This is not something we want. The growth is not there. We got flat lines and to negative. We just put these companies aside. Okay, so these visually, it's very easy to see whether or not we're going to take the next steps of looking to verify the quality characteristics. Okay, so back to this, it's very easy to look at something like that. It's very easy on the eyes, and it's something that you actually get eager to look more into. Okay, I want to know what these guys do. I want to know how they do it, and why is it they do it so well? What is their do they have some type of competitive advantage over their peers, and what is that, and how sustainable is it, that kind of stuff. So that's kind of stuff you want to be thinking about when you see something like this. I want to know the rest of the story. Okay, we talked about pre-tax profit on sales. All right, this is a different kind of graph. That other graph that we saw here, this is called a logarithmic graph. It straightens out growth, which is what we want when we're looking at our visual analysis. This is not that type of graph. We're no longer on a logarithmic graph. So we're just what we want to see here. Remember, we either want steady or growing pre-tax profit on sales. And so we're looking at return numbers up here. So we want to be flatlining is not a problem. We expect it. This is a company that has been continually improving its pre-tax profit. Somewhere it's going to flatline, and that's all expected. But this is really outstanding growth you're seeing in this example. Same with return on equity. Remember, again, same thing. We want steady or growing, and we have growth. It got pretty steady here for a few years, and started to grow again. So awesome, well managed. This is the company showing that not only from the previous slide that they can make you money, they do a good job of making money, and then they plow that money in and back into the company to keep that machine, that business making money. Okay, and all good stuff. We talked about debt, right? We want to see debt. You look at a company, and this I brought in two lines. I'll explain that orange one in a minute. The black line is the company we're actually looking at. You look at a company here that this is one that doesn't fund any of its operations. It doesn't have debt in its capital structure. It just does not do that. All of a sudden, it did it in 2014. That's one of those. Okay, why? And how much was that? Did it put me at risk? Or maybe they just borrowed some money because interest rates were low. They're looking to maybe making a purchase another company, some type of acquisition. But then, immediately they start paying it down, and then you want to see what the rest of the story is. Most likely, you're going to see a company who's managed this way over all these years probably get right back to zero. But then you have what you see in this orange line. Okay, so I mentioned to you that you want to be invested in the leaders of an industry, right? And so looking at this company information in isolation is okay when it is all good in trying to understand the company that you're learning about. But you need to know how that company stacks up to its peers. We want the leaders in industry. So we bring in the peer group information, and this is just one graphed line of that. So you can bring in several peers on the same graph. You can bring in peer averages and such that will really help you determine whether or not you're looking at the industry leader. That's the reason I brought the this orange line in, and to show you that here's two companies that are in the same industry. One doesn't use cash or debt at all, so you're putting your stockholders at less risk, where the other one uses debt all the time and various levels. This is annoying to someone like me. I would have to really understand what they do with debt to see if this is okay, and because those are some pretty big swings going on there. There's no consistency of it. When I mentioned to you how there are companies that use debt as part of their capital structure regularly, that's just the nature of the industry. You'll see this line relatively flat. It'll bounce up and down very little. This is extreme, and I would need to know. But so that's again part of that story. If I'm going to own two great companies in the same industry, would I want this guy that plays with debt like that, or this guy who can finance themselves without debt? Those are things we talk about. Okay, quick review. All right, strong and consistent sales, strong and consistent earnings. We like those lines growing upwards, very straight. Okay, when it comes to sales and earnings. And we like to see, and we always do really, we want to see those 52-week high and low price bars marching right along that earnings line. You'll see it you'll see it in any good quality growth company. It may not be immediate. You may go through a months when you're your stock price is barely moving, and you're just like, what is going on? This company is just knocking it out of the park. It is growing. It's growing steady like it always has. Why isn't the price moving? Mr. Market's a weird animal. You don't know what it's going to do sometimes, but eventually, some of us will call it the inchworm effect. You will get that bump. That price will move. Mr. Market will identify it at whatever point, and up it goes, and it'll be right where you need it to be, or as you would expect it to be as an investor in the company. Steady or growing, pre-tax profit and ROE. PTP is pre-tax profit, ROE, return on equity or return on shareholder equity, and then the low debt. Okay, low to no debt. Okay, so once we're good, and only if the company meets all the things we're looking for with regard to this information, do we take that next deep dive into the fundamentals. Okay, we want to make sure that we're good, right? We're build that comfort level, and now we're ready to forecast sales and earnings. This is where it starts to get fun. Now we're looking at this thing as a potential investment from a stock investor's perspective. So what do we want to do? We talked about we need to have a good understanding. We have to have that warm fuzzy. We need to be comfortable with how the company has performed, how it grows, what it does. Okay, we need to be comfortable. And then you use the information, and this information is all readily available. We actually quick link most of it where you can just reach it right through the online tool. There's a research drop down, and we'll take you to where you need to build that warm fuzzy to get that information you need. And once you have it, right, now you're ready to make reasonable. Okay, you're not going to make exact assumptions about the future. None of us know what the future is, but based on some guidance, okay, and making some using some of the structure that we use when it comes to making forward-looking estimates, we're gonna make sure that we make reasonable we set forward reasonable expectations for this company. We're not into, oh boy, a company like that. Could you imagine if it grew at 20% when it's only been growing at 14%? Was that smart? No. Okay, we're reasonable, and that's why that word's underlined. It's critical, and we show you how to do this stuff. All right, so we're going to make some estimates about the company's future sales and earnings and what that potential looks like, all to get to that high and low that we expect the company to achieve, hopefully over the next 5 years. So there's lots of things you consider. Okay, we've seen the line, we've seen the graph data about how the company's been growing, but what does it plan to do to grow sales? Okay, we get it. You did this. Now, what are you going to do going forward? How are you going to capture that market, maintain that market, even capture more market share? How do you plan to do that? And we're going to look at the same. We're going to talk about earnings the same way. And we're looking for drivers. Okay, what are the things that are going to drive that growth? We're going to see if there's any competitive advantage that one of the companies in the industries we're looking at has over the others. That can be dynamic. It may not be forever. A lot of times it's not, but depending on what kind of an advantage it is, a company can benefit from that for many years, and you want to be riding that ship. Okay, so we want to talk about a number of things when we're doing our research, all on our own, and then we want to talk about, well, what are the analysts saying? These good quality companies have lots of analysts following them. What are they saying? These guys, it's their job to follow these companies. Well, what are they saying? And we use those guys as a second opinion. Typically, we want to understand the company as an investment. That's critical. We don't just expect to be told, here's a great company, go buy it. That's the great way to lose money. Okay, so don't do it. Do your homework. That's critical. Understand what it is you're investing in. You worked hard for that money. Don't just hand it away. Okay, so we're going to talk. We're going to do our study. We're going to see what the analysts say. We're going to look at the competitors, and then we're going to find out how they stack up, and we're going to look more deeply into the guys on top of the game. Once we have it, we're going to start talking about the future, like I mentioned, and that's this part of the graph. Here's all the history we just dug into and got a nice warm fuzzy about it. Now we need to project where that trend line, that thin little line I've been pointing it to, where does what does that guy look like going forward? We have expectations that we've come up with in our research and in our digging and learning about the company, but we also bring in the analysts. When you see this green dot, for instance, that's actually a straight green line in there. That's the analyst estimate for revenues over the next 2 years. Here's the analyst estimate in this light blue line over the next 5 years for this particular company. So there's guidance built right into the tool. We set our expectations with this dash line. There's various ways we come up with those growth expectations. We're looking to estimate a growth rate here for how is this going to continue to grow. All right, and this is where, when I mentioned we have the data and growth rates and such on the screen, here's where that sits in here for us. And there's actually more of it. There's 10 years of data back here, but I just took a chunk of it. But you can see here's historical growth rate right here that I'm buzzing around with my red arrow. That's what this company has been growing at over the past 10 years. What we need to do is forecast the next 5. So this is just this is what you're seeing here is for just demonstration purposes only. You would most likely never put such a low growth rate against a company that's been growing at the rate you're seeing here. Okay, that's if you felt that the company was only going to grow 14 when it was doing this, you wouldn't be looking at this company as a potential investment. Okay, it would have failed already. So this is just to demonstrate how we arrive at the numbers we use to build out that future high and low price. Okay, so I need to generate a reasonable sales growth rate and a reasonable earnings growth rate. And when I put these numbers in here, that moves these dashed lines into the position you see them. Okay, so you come up with reasonable expectations about sales and earnings growth over the next 5 years. Those expectations, those growth rates are going to lead to particular numbers. Okay, a revenue number 5 years out, as well as this earnings per share number. In this case, it's 965 you see here. This is the number we're going to play with when we start to talk about building out that potential high-low price. We need this guy. So let's keep moving. We've moved right out of sales and earnings, okay? And again, I did that quickly, and we have all the education and guidance you need to get a handle on how to put those reasonable expectations together. And same with this next section that we're going to enter right now. We're entering the risk and reward. This is where we start to build out that estimated high price and low price over the next 5 years. So let's go in there, and this is just a piece of the screen that we work on during this part of the process. This is out of the tool. And remember the $9.65 in earnings that we estimated? That's this guy right here. So our high EPS, earnings per share forecast, is just automatically brought in here. You can change it if you want, but this is automatically brought in by default. The reason we need this is because that earnings is a part of this simple little equation where we multiply earnings times a PE ratio to get to a price. This is where we want to get. Okay, but to get to that price, I need this PE. We already did the earnings. We see that. I need this PE. What's the average PE look like? Price earnings. I'm sorry. PE is the price earnings of the company. This is a ratio that the market uses to see how the company is being valued. When I mention about a company being highly valued, you'll see that typically in its price earnings ratio. How much is an investor willing to pay for $1 of the company's earnings is what that's telling you. So it's just like anything else you buy. You buy coffee for so much a pound, you pay so much to $2, $3 a gallon of gasoline. Same kind of thing, but this time you're buying earnings. Okay, that's what this is. So it's how does the market value that company's earnings? And we talk about this. We get you comfortable with what PE is all about, how it's not, there's no exact science to how the market values things. The market is a strange beast, okay? It's a very fickle thing. And but it's one that you get comfortable with actually quite quickly when you invest in companies that we invest in. Okay, there's not a lot of built-in uh, fear of crazy things happening to good, solid growth companies. The market expects them to continue doing what they do. So the PEs, the way the market values that company is pretty stable, as opposed to a high-flying company that's up, down, and all around. It keeps growing, but it does so in a very crazy way, an erratic way, and you never really know if it's going to be up or down. So how do you price that thing? Yeah, so there's the PE can be very abstract when it comes to how it's applied to certain companies. But in our case, it's pretty consistent, pretty stable, and then that's why we use it. It's why we rely on it so heavily. It is a stable value to use in this study. So based on all the things we look at when it comes to PE, and I'm not going to get into a deep dive there again. Remember, I can't go into the weeds in this presentation. But this once we've put together a reasonable average high PE. We're looking for an average high PE forecast. So what we think this average high PE would be over the next 5 years. We then have the two pieces we need of the puzzle, which automatically then generates this projected high price. Immediately, we look at it in relationship to the recent closing price. And we do that because sometimes you may have goofed. Your projections may be such that your price and the forecast don't jibe. And I'm not going to get into that. It's too much detail, but that's why you see it there immediately. We want to take a quick look. And there's other guidance built right into the tool here that help us get a better handle of that average high PE forecast we need to make. Once we're done with that, we want to move on to forecasting the low price. We need that. We need the ceiling, which is the high price, and we need the floor. We need that big bracket of what we think the price range could be of this company. So same principle, okay? PE, again, we're going to use a PE times earnings to get to a price. Same formula. This time, for the PE, for the earnings, we're going to use the trailing 12 months or the last 4 quarters of the company's earnings per share. In a growth company, the last 4 quarters earnings per share should be the low because it's going to keep growing, right? If it continues to grow, then those last 4 quarters would be the low. Okay, so that's all that is. That's an easy one. That's why you see it's given here. We can play with it if we want, but it's a given. Then we need that PE. So we're going to look at the PE in relationship to growth and a number of different things. What's going on with the company, the market, blah blah blah. We're gonna do our thing in putting together a reasonable expectation of what the average low PE would be in this case, and we come up with it. Okay, it's all well thought out. Believe me, there's no guessing. We know it's not exact science, but we can feel comfortable about these estimates. Okay. Once we have the two pieces of the puzzle, we're now able to generate the low price, potential low price we could expect to see over the next 5 years. Once again, we can look at it in relationship to the current price and just real quickly see if we're being reasonable right here. Okay, and again, there's more to that story. And there's other ways that we can choose low prices, and we have that information built in to the tool. But when you're getting started and you're focusing on investing in these solid growth companies that have graphs that look like what we're talking about, okay, this is the best way that you want to come up with the potential high and low price. Okay, this is what we want to do. So from here, we can start to bracket out, like I mentioned, we can lay in the current price in between the forecasted high, which you see up here, 250.90. The low was 107.80. And then here's the current at the time was 152.60. What we do is we break the difference, this range up into the top 25 closest to the sell or closest to the high is the sell zone. 50% in the middle is the hold zone. And then there's the buy zone closest to the forecasted low. We want to be obviously in the buy zone, right? When we're looking to buy. So this is what tells us whether if the company is currently overvalued and not really a good potential investment. All right, we want to be buying down here to reduce our risk. We want to increase our upside potential and reduce our downside potential. Upside being growth in your investment, downside being potential loss. Okay, that's a four-letter word for a reason. Okay, we don't want any part of it. All right, so we're conservative, we're patient. Again, we don't just buy into these companies as, oh gosh, this is a great growth company. These guys are just killing it in their industry. Well, that's nice, but that doesn't mean you just go out and buy their stock. Okay, no better way to lose money than to overpay for a stock. Okay, and this helps us see that visually. We want 3 times the upside at a minimum to downside when we're looking to buy into a company. And this is where patience comes in, because it can take a while, and sometimes it may not happen for the price to fall into that buy zone, because the market just keeps propping up that company. It doesn't become a good investment for you. That happens, but we're going to be patient, because we're going to buy when that potential upside is 3 times or greater. Okay. Valuation and return. We've looked at, we've made all the assumptions, our estimates and forecasting we've done. We've got where we think the current price sits as a potential investment. But what does it look like from a return perspective? We're going to look at the total return based on those assumptions we made and based on what the current price is. And we see 2 components here. With the rate of return, you've got the capital appreciation. Okay, so that's the change or the movement in the price of the stock itself. And then you've got income appreciation with stocks that pay a dividend. If the company does not pay a dividend, then you would not be looking at an income component to the return numbers. So let's take this language to numbers. So in the tool, we would see in the very next section, from when we were looking at building the buy, hold, and sell zones and the upside downside ratio, we look at this return. We see the potential annual price appreciation. Okay, so there's that capital appreciation we could expect. Okay, this is based on assumptions. If our assumptions come to fruition, we could expect somewhere around a 10% price appreciation of just the stock itself. In this case, we see a yield number, which means the company does pay a dividend, and this yield figure gets added right to your return. So when you add the 2 here, 10.4 and 1.1, we get a potential annual rate of return of about 11.5% based on the assumptions we made in our study. Okay, and it gives us a current yield number from there. That's how we start and get to the finish line. That's high level. There's a lot to know and read in between the lines. That's like, as I mentioned, is left for another day. We have lots of presentations that we do to help folks just really warm up to everything I've mentioned to you in a high level here. There's an introduction to stock selection series that I recommend every investor who comes into our door take that series. There's a second one called adding your judgment. So it's helping you get more comfortable making those estimates and those judgments going forward. Those two series really do a great job of spelling out all the nitty-gritty that I just blew through tonight and blew over. All right, but it's very important to hear that, to listen to that story, how we look at all these different things in detail. Very important. Okay, so let's move on. Real quick review, right? We found those good quality companies. All right, we verified all that information that we saw very clearly in the visual analysis, but we verified it. Okay, it's all good. We got it. We got this. We built ourselves a nice little comfort level so that we're not going to waste our time putting a potential value to a company that isn't worth even looking at. Why would we do that? That's a total waste of time as an investor. We don't do that. Okay, we only get into those estimates when we have a real good solid company that we understand on our hands, and then we do those estimates, and we do them right. We do them reasonably, and we get comfortable with what we've put together there, so that we put together what our potential buy, hold, and sell prices are for that company as a potential investment, and then we look at the return. How does it all fit together? So it's just that's the big umbrella.